Okay, guys, thank you for being here with me today. Unfortunately, I cannot join in person, but I would love to present you this dilemma if CBDC is really a threat for crypto universe, because there are a lot of contradictory opinions. And hopefully, after my presentation, we get at least more clarity where we are, where are we going, and why I think personally it's not a threat for the crypto universe whatsoever. So first of all, let me reflect a bit on what's really happening in the payment space in Eurozone. And I'm sure everyone witnessed it themselves that the share of cash is declining. Actually, year over year is declining by 6%, and it's a significant number. So in everyday payments, we use less and less physical cash to pay for our needs. Plus, some additional legislations that came into effect last few years banned cash payments of over 10,000 euros equivalent. So that also contributing to this decline. And obviously, the digital payments across all of the spectrum of payment channels have been rising. It's cards, credit cards, debit cards, all different payment interfaces. So in a sense, euro is already digital. Whether we kind of feel it or understand it, it's happening. The significant part of all payments that are happening through our general consumption of goods and services is already digital, and the trend is accelerating with 20% growth year over year. What's interesting is that the crypto is not part of the statistics at the moment, but stablecoin market has been booming regardless of crypto trading up, down, sideways, altcoins dropping or rising crazily, ICO, IDO, this token generation events, meme coin money. Regardless of all that, that is cyclical. The massive trend in the stablecoin market, and as you can see, the market cap of the stablecoins is already a healthy 150 billion, but the number of transactions, number of holders, individual wallets holding stablecoins, number of transfers, and total volume, which includes DeFi transactions. So in a sense, they counted several times. But the point is simple, that if we extrapolate the growth rates for the 2024, what has happened already, it's already exceeding historical norms, the stablecoin transaction volume. So that's just another confirmation that we consume a significant portion of our digital assets in the form of stable coins, and that we use them to pay our suppliers, our contractors, pay salaries, do cross-border transactions, and obviously use them for speculative purposes to trade in DeFi and on centralized exchanges. But to make another argument about the share of digital payments, it's also a part of that statistics, which is not yet public because until MiCA, the stablecoin has not been accepted as a legal mean of payment. So MiCA will change that, but that's a topic of a different conversation. So what exactly is a CBDC and why people think it could be a threat? Well, obviously, the central bank cannot just sit and watch that there is such a massive demand for digital channels to pay and to receive and store assets and money. So what they were starting to look into is to introduce some technical solution where customers or say individuals have access to direct central bank account with some say form of money or some balance of that account. And I argue that it will be just a replacement of metal coins for a number of reasons, but let's just reflect on this. So, okay, imagine you have an account in central bank and you've got some wallet from central bank, right, where you can store some funds. What will happen is you will immediately move funds from other commercial banks to that account because in a central bank, supposing that there is no risk, there is no credit risk, the central bank cannot go bankrupt, it cannot be liquidated, right? And so your deposits cannot be lost. And this is what central bank is not allowing to happen, because if a commercial bank system loses deposits, then it will not be able to lend money to the economy, and then the whole economy will shrink massively. So central bank needs to figure out some solution which, first of all, must be available 24/7, online or offline, in all of the 27 member states plus EEA area, in all remote places where there are no internet or maybe not even electricity. There are some places in Europe which still do not have electricity, or it's not 24/7. And central bank has to provide a technical solution which will work there to replace some form of cash. Why is that? Because central bank is a mandated institution. It has to create something that has a legal tender, legal obligation to be used in all payments and services across a nation, across the country. So it has to be some solution which basically will be a replacement of some physical cash, some money that anybody can access and give to a service provider or supplier or point of sale, grocery store, post, I mean, you name it, or even a taxi driver. And obviously, it will come in a form of permissioned, some centralized infrastructure. There is no point of using any open source blockchain here. It will be some centralized database that will store this information about particular users, particular accounts, and their balance. So let's look at all the setups that are currently either in operation or in design. So, okay, you've got these commercial banks that have accounts in central banks, right? And that can provide accounts to individuals and corporates. The safeguarded limit there is 100,000 euro. That's the amount you are guaranteed to be compensated if the commercial bank goes under, because the commercial bank is a credit institution. It lends money. It uses a bank multiplier. And if the bank on a run happens, the bank may not have all the money to give all to depositors. We just witnessed another situation with Credit Suisse, which lived 150 years, and then in a few weeks' time, it collapsed. So in order to keep economy going, there is this insured amount which protects depositors and make them feel safe to deposit money with commercial banks. Now, on the right side, there is this central bank account, right, which will offer you the way to send and receive some form of digital euro, which we call CBDC. And interestingly enough, it's impossible to have unlimited balance there, right? Because then anybody who is keeping funds in the commercial banks will move money to a central bank, and the whole commercial bank lending market will collapse. So CBDC is already designed in a way where it has a strict account limit. In its current tech paper, the limit is just 3,000 euro per account. So on the other side, there are stablecoin issuers who will be MiCA licensed, who will have some rules how they segregate their funds. And under PSD3, which is a Payment Service Directive 3 coming online 2027, they will have access to central bank infrastructure as well. So a commercial stablecoin issuer is something that is regulated, that is unlevered. It doesn't have any bank multiple or this one-to-one, always one-to-one reserves, invested in some government bonds, which is the safest way of allocating funds to generate some yield. Then it will have the central bank accounts. Actually, we pioneered this setup. Our stablecoin stores some of the reserves in the European Central Bank. And then it will have some commercial banks, because under regulation, again, there is the same dilemma. If regulators allow this narrow banking, it's called concept, then people will move money not to central banks, but to, say, commercial stablecoin issuers who have accounts in central bank, right? So this is why if you want to get any yield on your fiat instrument, the only way to do is to access a commercial bank deposit. If you want to have the flexibility of issuing a commercial digital euro, at the same time properly safeguarded, you could buy MiCA-regulated stable coins. You won't get any yield out of these issuers. We are restricted to paying yield for the same reason, because we're allowed to have the central bank infrastructure, central bank accounts. Or if you want to access pure central bank money, it is exactly what will be called CBDC. But keep in mind that given that there is a very low limit, just 3,000 euro per account, and I think the banking lobby may push it even further down, because 3,000 doesn't make sense for them either, and then it's just a replacement of metal coins we used to keep in our pockets to pay for, say, parking or a trolley in the grocery store. Usually when there is some consultation about particular regulation that is coming, the limits are only going down, not up. So in the first one, the limit was 3,000, but I anticipate in the final version of this CBDC product, the limit will further decrease. So where we come into this and how we became the biggest euro stablecoin on the market. We always thought about the stablecoin as a regulated product, and I was the first to introduce some form of regulation in Europe with the help of the local government back in 2018. And then we also were the first to bring a proper auditor to the table to audit the product and to provide customers with the assurance that the assets are held one-to-one. And then also a significant boost for our adoption happened when we started accessing the central bank account in Lithuania and making payments from that account on behalf of our customers and receiving funds there, because it was very convenient, safe, and fully electronic, fully digital. So you could argue that a commercial stablecoin issuer who holds money with central banks is also a form of CBDC. But the difference is that it has no limit per account. It runs on public blockchains, so it's fully programmable. You can do whatever you want with it. It's self-custodial, because the CBDC from the central bank will not be self-custodial. It will be still a centralized database storing information about your account. Also, CBDC will never generate you any yield, while the commercial stablecoin under MiCA, which you self-custody, you could access some yield in DeFi strategies, which is relatively safe and not regulated for now. And then, yeah, basically that's my argumentation for to prove the fact that CBDC will just replace our metal coins, which, by the way, are already a drag on the economy. In order to circulate these coins through the economy, commercial banks and central banks have to pay significant costs, because all these coins need to be minted, they need to be collected from the commercial banks, they need to be circulated. So it's already economic benefit if consumers switch from something that represent euro in its physical form, in form of coins, into CBDC, which will be same basically product, but in a digital form. Or you could expand your options, what you can use with the digital euro by accessing privately issued stablecoins that are regulated in Europe. So please, if you want, you can try accessing our stablecoin. It's very, very simple and easy how you can get a hold of it. Or even we are short in time here, you can follow up with any questions you might have. That's my Twitter account on the left, or my email, or even Telegram. I will leave this on the screen for a while. Thank you for your attention.